So this is a public market basics, but in reality, there is a lot packed in here. I only gave one of these presentations almost 8 years ago, and it was a lot less what we have here. The result of that presentation is that it landed 2 unicorns within a 5 to 6 years period of time. In fact, I hope that this presentation is more full than before, but it really depends on the questions that we get and how people get to understand it, because the other folks here understood it very well. They executed it completely. And one of the unicorns is a very famous unicorn in the US, and the other one is in Southeast Asia. So it works in all places in the world, utilizing the US system. Okay, let's see. Let's start going through the presentation, please. It's a very quick disclaimer. What we're going to talk about is the market fundamentals, the foundation of the entire market system. It pertains to every place that is related to the Amsterdam Stock Exchange, which that includes the London Stock Exchange, which includes definitely the US Stock Exchange today. And it used to be also part of what the Shanghai Stock Exchange was in the old days, not the present days of the Shanghai Stock Exchange, but the past Shanghai Stock Exchange. Those are the foundation. But today I'll be focusing only in the US market and in the ecosystem of the entire market. I won't be able to go into all of the ecosystem because over the past 200 years, that ecosystem has grown over and over and over again. And so that's why the US has a lot of the services and functions that no place in the world, not even the London Stock Exchange, Hong Kong Stock Exchange, Japan Stock Exchange, Europe, the other ones are very midget, like Australia, New Zealand, Canada. All of those are very midget, stock exchanges. And so this is the first, topic. Then the second one in here is going to talk about the company in itself and what is important to be able to, have a properly built company. The third one is where the meat and potatoes is. That's what everybody is coming into this seminar to listen to, how the trading system operates, how the various components of what makes up the ecosystem of the US financial markets and here come into play, how is valuation utilized, and so that is what we call, or what I call, market dynamics. And the number 4 is how things are structured to be able to get to that market dynamics, how they're executed, to that market dynamics, and particularly how does it go from into the IPO, out of the IPO, and into long-term sustained trading. Obviously, the IPO is just the opening of the door, is the first day of the large, public offering, but it's not the, it's not. A lot continues afterwards. And the number 5 in here is we'll talk about operating and sustaining the value. I want to point out something very important, is that if things are done well in the very beginning, then getting to 4 and 5 is actually possible. If things are not being done, from the very beginning, then there's practically almost impossible to go and fix it, because the system is a highly complicated system. It operates with very fundamental, simple concepts, but it is a very complex systems of things. Okay, and of course, the U.S. makes it very, very simple to go in and especially at the higher tier of the business. And so let's get started. Number one. On the right-hand side is a simplified version of the ecosystem. And I'll explain it like this. The public market ecosystem is composed of three major parts. The business part. This is the company. And this is what the public market is buying into. So if you are a potential investor or you are a fund manager and you want to actually buy something, you are actually buying into a company. And so the company is the most important thing that we have to remember. Number two is the market machine or the public markets, and that is the investment part. That is the investment part. When you say, I want to go and invest in Tesla stock or IBM stock or NVIDIA stock, you're talking about that action of going there and the mechanism for you to be able to acquire that stock, that ownership in the business. And that is what investing is all about. And that market machine, the market machine is what determines the price and the liquidity, and is what also determines the valuation. This is very important you understand, because a lot of people go and theoretically calculate the value of the company, and they demand that everybody pays them that value. At the end of the day, that does not work. The only thing that works is that the market, the public, determines the price, the valuation, and the liquidity. Liquidity meaning how many people are willing to buy how many shares of the company's stock, or how many people want to sell the shares of the company's stock. That is called liquidity, the process of a buyer and a seller. One side is not enough. You cannot have a buyer and no seller, and you cannot have a seller and no buyer. For liquidity to occur and for the stock market to occur, there must always be a buying side and a selling side. That's what a market is. If you go to a supermarket, or if you go to a farmer's market, there's somebody selling carrots and somebody willing to buy the carrots. Is an exchange in it. The stock market is really operates exactly the same as a farmer's market, in my opinion. Actually worse, more dynamics, more emotions. The third portion of it is the team, is the people, and it's also the institutions that make the whole thing works. Okay, it's not one business company is here in the market, but it's also the people, and it's not only the people in the company, it's the financial advisors, the lawyers, accountants, service providers, market makers, everything. And that is the entire network that is required to make up the system work. Okay, any questions? Is that clear? The business, in the center is the market, and then you have the people. People inside the company, people in the market that do the functions that the market does, and the people that are actually combining the pieces together, like a financial advisor that is a person between company and the service providers. Next.
One question.
Yes.
What about another factor that is almost coming from external, like political goals that might manipulate the market by creating news in a certain direction, for example?
Okay, that's a very good question. In the U.S., the stock market is not directly linked to the government. Put it another way, that the investors in the market don't pay attention to what the government tells them to do. It is a free economy, and so the government has no power over the stock market unless the stock market does something illegal. They could close it down, but that has never occurred. And that's number one. Number two is that most investors, and I'm talking about institutional investors, they will factor in the geopolitical and the politics that the government has.
Mm-hmm.
But government, if they issue a law and they issue a decree, whatever the government does in here has practically no effect on the public markets in the US. I'm speaking about the US in particular.
Mm-hmm.
And the reason for that is because the US and also most exchanges in the world are private markets. They are not owned by the government. The China market is one of the few that is owned by the Chinese government. The Chinese government can shut it, can manipulate it, can do anything it can, but the US public markets, British public markets, German public market, well, the euro in general, even the Japanese, stock market, they are all, public, owned by corporations, owned by individuals. And so as an investor or as an exchange, neither of them are directly, affected by government regulations. Okay. Now, there may be some laws that are passed to be able to tighten up certain things, but that normally is done by means of rules and regulations of the entire marketplace. One such example, which was a long time ago, was the 1933 and 1934 Act. If you go back to your subscription agreement that you sign when you purchase a share of stock of the US, it will say this is based on the 1933 Act. Okay, that was the major act. Ever since 1933 up to now, there has been practically no change through that 1933 Act. There's been modifications. One such modification was the Jobs Act, but the Jobs Act was mostly for reporting and affects more the company than affects the actual stock that the people buy, in the market. Okay, is that satisfactory? Okay, very good. A good question.
Yes, thank you very much. Yeah.
Absolutely. Okay, so now that we've spoken about the totality of the public market ecosystem, I want everybody to know that just because our company or any company is great, it does not mean that it'll be successful in the public markets. Great companies can fail in the market. Many of them have. They do very, very well as a business, but they have a very, very poor performance in the stock. And that's one reason. For example, many Chinese companies, they have actually, they were making a lot of profit, large amount of profits, but they were not able to portray, what they have to do. And so those companies in here did not make it, very well in the market. But it's not only China. I'm just pointing China because about up to 3 or 5 years ago, China had some formidable high growth companies, high earning companies. But they did very poorly in the stock market. Okay. So, and the reason for that is because they are very weak in the investment layer. They're very weak into the market layer, despite of them being a strong company. Okay. So the other thing in here is that it should be no surprise to you that a bad company can actually do very well in the stock market. Okay, a bad company can get a very high valuation in the market. I'll give you one example. Tesla is not a bad company, but Tesla's valuation is extraordinarily high. Tesla valuation is over 200 times the PE. There is practically no company, in the public market that has 200 as a PE. And that is one of the traits that Elon Musk is very good at, is because number one, to be able to do good in the public market, you have a very strong narrative. How you present yourself, how do you communicate yourself? And number two, there must be a lot of capital flows, meaning that there must be a lot of liquidity, a lot of buyers and sellers. And so why do we want to have a fan base of 300 loyal people? Is to be able to have a lot of buying and selling in there, to be able to create that, because capital flows is the key to be able to have a good business, a good market. Okay, and that's why bad companies can get a high valuation and great companies do not. The last one is why IPO fails. IPO fails is very simple, is because the team did not execute properly. Okay, so when things are not done and not programmed properly, then the team was not able to put together, the IPO. Okay, now there's one thing in here I want to say at this moment in time. We have the business, the investing, the market, and then we have the team, the people, and the institutions. Okay, I want to take a few seconds in here for you to realize what are people buying. This is very important that people know this. Okay, and I'm going to say it in the most traditional way, because we're not in a speculative company, or we're not a speculative group of people. We need to know what we're buying. We are buying a fractional ownership of a company. When we acquire the stock of a company, by definition, and going back to the definition of Amsterdam and the Dutch system, we're actually buying a portion, a fraction of a company. As shares represent that a company is split up into many, many pieces, and we're actually acquiring a piece of the company. Because we're acquiring a piece of the company, we're expecting that that piece of the company and the company in general will be able to derive earnings. Because, as you heard me saying, that the main objective of a business is and only is to earn a profit. There's no second. And then lastly is that we're buying a company in fractional ownership so that we don't have to go and manage that company, and we are hiring a group of people that are managing the company for us for our fractional ownership, so that we don't have to go there and fractionally manage the company. Okay, that's number one. Number two is that why would people buy that fractional ownership? It is because of one word, and that is growth. Growth means in this case that the company will be worth more in the future than it's worth now. In other words, the company is expected to make more money in the future than it's making it today. I also will say that if the company cannot demonstrate that it can make more money in the future than it's now, it's not showing that it's got growth, and that company is not attractive for any investment from the public perspective point of view. Third is that for the market to be able to operate, everybody needs to understand that this is a pool of ownership. And the larger the pool, the better it is. Okay, so that makes the transformation of more fractioning of the ownership, meaning dilution, because you're getting a smaller and smaller piece of the pie. Your percentages are reducing as an owner as you're issuing more stock. So you need to make sure that that dilution is able to transform into more capital. If your dilution does not transform into more capital, then the company has no reason to be able to issue more shares because it cannot get more capital. So why should it be, fractionalizing even more the company? Okay. The other point is that liquidity is the single most important thing in the marketplace, and that transfer of ownership, it what makes people be able to acquire all shares so that they can actually take over that ownership of the company. And that desire and that demand that people have to be able to take ownership of somebody else's fractional share, and that somebody's willing to sell their ownership today so that another person can actually buy that same share for himself or herself. Okay, so that pooling of the ownership put into a place called the market where there's simultaneously bidding. Okay, so it's very important. Nothing functions in the market without a marketplace, and there's a bidding process where somebody wants to buy at one price and the other one is trying to sell at another price. Okay, and the more people doing that, the stronger the public market for that company, the more successful that company would be in the marketplace. Is that clear? Yes?
Yes.
Okay. So the last one I want to actually mention before we go into the planning here is the team that makes the ability of this fractional ownership works. Because it was no team that the fractional ownership of 1,000 people who is going to be running the company. Okay, you're going to be running the company for 5 minutes because your ownership of the company allows you only 5 minutes of time. It doesn't make sense. So the team in here is the one that handle the entire company so that it looks like an entire piece, although it may have thousands, perhaps tens of thousands or hundreds of thousands of fractional owners. Okay, so that large network of the management team with auditors, lawyers, accountants, market makers, investment bankers, the whole thing in here together, is what is able to manage the entire complexity operation of a company in something as complicated as a stock market. I don't believe that anybody can explain, me included. I'm making a simplification of stock market. I don't believe that anybody could totally explain the entire stock market, especially the U.S. stock market, because it is something that is so complicated that occurs over the last 200 plus years. Okay, that is the essence of this big picture that I show over here. Is that it looks good, it feels good, but there's many pieces that are behind here that nobody knows in totality. Okay, next. Okay, so the business, and this is what the market is buying, right? So the key portions in the business that are important to be done and must be done well, but they must be done, is that the company must have a business model. That business model is able to show revenues, margin, and whether that business can scale. Because if the business cannot scale, it won't have growth. And if it doesn't have growth, then nobody will buy the stock. Nobody will make an investment. There's no reason why. Okay? Secondly, it's got to show financial performance. The main financial performance it needs to show is earnings per shares. It again needs to show growth. And it needs to be able to show cash flow. Next is that the company needs to show that it's got corporate governance. because without corporate governance, the public will never be able to trust the company, because you don't really know the company, any company, like Berkshire Hathaway, you're dealing with 300,000, 400,000 people. There's no way you'll be able to manage or see whether these 300,000 people could be trustworthy or not. Some of them are not. But what makes that complex, large body of people, of entity, be trustworthy is the corporate governance that the company has. The other elements, and that is also very important, not only for ourselves, is that all public companies are always doing mergers and acquisitions. They are always trying to expand, and they're always trying to allocate their capital properly. Some of them doing better than others, but that is the fundamental key strategy that a company needs to show to be able to show that it's a good company worthy of investing. Now, the last one, as I told you, a good company may be bad in the market. Why? Is because the last one in here, the narrative is not proper. And most companies do not have a narrative, or they cannot communicate the narrative. That's the story, the vision, and the positioning of the company. Okay? And whenever you have a company that has all of the business model, financial performance, corporate governance, strategy, but you cannot articulate it and you do not communicate it, then nobody will know. Because there are tens of thousands of companies out there. Everybody is saying something, and if you stay quiet, nobody will find out, especially if you're a new public company into the big complex of the market. Okay, so the narrative, in my opinion and experience, is what takes all other three in here and makes it visible to the public market. Because if you have all four and you don't communicate it, nobody will find out. Nobody goes out there in the filings. There's nothing that shows that there's a strategy. There's nothing that shows that there's a corporate governance. The EPS, you may be able to show it. The business model, maybe you'll be able to show it. But it's through the narrative, through the vision and the storytelling. So that's why the public market is a place where people or the companies tell their story and attract buyers. Okay? The last point in here is a cute one, but it's important. A stock, although it's shown as a ticker symbol, the most important thing is to remember that it is the business system, and that business system must be packaged properly, for capital. It does not occur naturally. It's not like a tree that grows. You have to force it into being a package with all of these 4 or 5 pieces to be put together into a package. Okay? This is the business. This is the company. And this is what people are buying into. Don't ever forget that. People are buying into a fraction of the company. I know that people buy so that the stock price goes up and they can actually make money. That is not what we're talking about. That's called speculation. We're talking about a real investment. Okay. The market. As I said before, the market is what determines the price, the liquidity, and the valuation. In the pieces in the market, and this is a very, very simplistic numbers of elements that compose a market, but there is the buy side and there's a sell side. There's a buy side ecosystem and there's a sell side ecosystem. Okay, and there are some ecosystems that serve both, left and right. When you open up a stock brokerage account, which is the only way that you can actually buy a stock in the public market, that account that you open up allows you to buy and also allows you to sell. Okay, so the brokerage account is a mean by which you are able to participate in the public market. Okay, who has a brokerage stock account? Raise your hands. Good, good, everybody. Okay, so the other element of the market is that the market is got several kinds of people, but typically I like to be able to include institutional participants and retail participants. Institutional participants are typically sophisticated buyers. If they're not sophisticated by themselves, they have a lot of sophisticated information. So many of these institutions can afford to have 100,000 or even $1 million report. A retail person cannot afford to do that. Okay, so you have the institutional players that are buying and selling its stock, and you have a retail players that are buying and selling stock. Okay, then there are what I call the valuation mechanisms, which is the public market is very, very much simplified to price earning ratios, PEs, multiples of PEs. And another very important valuation that nobody speaks about is the market sentiment. Because the valuation and the price of a company can go up if people are optimistic about the company. If people are pessimistic about the company, it's going to affect the valuation downwards. Okay, and so that's why Tesla, as one of the best examples, has created an incredible sentiment, even though at the beginning of the company was still struggling. Okay, the next one in here is the trading dynamics. The trading dynamics is something that it could be manipulated, but the trading dynamics in general is what creates the liquidity, which is measured in volume. Number of shares traded per day, number of shares traded per week, number of shares traded per month, number of shares traded per year. And also the volatility, okay, because the stock can move 1% per day, or some stock move 1% per month. And that lack of volatility is actually undesirable for market dynamics. If your stock does not move up and down at least 5% per month, that stock is dead. And so that trading dynamics is not very good. Okay, and so of course sometimes you don't want the company to be swinging in prices, but a company that swings in prices is attractive to the market, and a company that does not swing and stays at a fixed price is nobody wants to look at it. The last one in here, at least in this list, is the market cycles. There are bull cycles of everybody being excited, and there are bear cycles where everybody's getting depressed. Eric's comment may apply, so that when the government issues a mandate, people get depressed, then of course then the people get into a bearish position. Or maybe the Federal Reserve issues a negative news on the interest rates, and then it turns the market from a bull cycle into a bear cycle. Okay, and so those are the market cycles that occur. I have some example of those later on. Okay, and then I'll finish by saying that the market does not price the company. Capital flows do. In other words, when you have volatility of buying and selling, that is what gives you the price of the market. The market is a big engine, but that engine doesn't do anything until there is a capital flow of a buyer and a seller. then that determines the price, of the company. Is that clear? That's why it's called an engine. I call it a market engine. I don't call it a entity of any sort.
One question, how is the price being determined if you have multiple marketplaces for one market? For example, I'm not sure about stocks, but in crypto, you have several crypto platforms like Binance and Kraken. They all have their marketplace where you have some liquidity and the prices could even differ. I think there are even some brokers that do arbitrage trading then. How is this with stocks? Is it similar or?
Well, okay, it's not. Stocks, well, crypto is something very new. I try to avoid everything that is new. Maybe 20 years into the future, the arbitrage will start eliminating in it. But in equity, for one thing, you can have that stock which is listed in the New York Stock Exchange. It will be co-listed in the NASDAQ. It will be co-listed in Germany, whichever is the relationship portions of it. The arbitrage price of it is practically zero.
Okay.
Okay. There
Yeah.
may be a situation where in the public markets, but it is in the over-the-counter markets, that could be a discrepancy into marketplaces, and you may be able to find some prices to be slightly different. But in
Okay.
general, bond markets and equity markets are highly liquid, and because of that, the prices tend to be, very much the same.
Yeah. Thank you.
Good question. Okay, and so that is the market in general. We'll come back to the market, but I want to finish with the people, with the team, and the team of the people inside the company, outside the companies, institutions, large institutions. The government is also considered an institution. So let's take a look at this entire network that greases the public markets. So first of all, you have the management of the company. You have the CEO and the CFO. Typically, the two most important management positions in a public company is the CEO and the CFO. And in many cases, the CEO has much more effect on the markets than the CEO. I don't recall which company it was, but I think that one company had the CEO that quit or died, and then another company where the CFO either left or died. The company where the CEO left or died, nothing happened to it. The other company, the CEO stayed, but the CFO left or died, and the company stock just went down the drain. Again, this is something very, very, that's the case. Secondly, is the group of investment bankers. Investment bankers are the people who take on the job by signing a contract to be the underwriters for the IPO. When they're not the underwriter for the IPO, they do other things that has to do with the investment portions of it. The confusion is because they're called investment banks, but they actually have nothing to do with banking. You could just call them an investment provider, or even more than that, they're just a financial service provider, because neither do they invest. So investment banks don't invest, they don't have money, and neither are their banks. So you could ask me, why are they called investment bankers? I don't know, but that's what they call. So investment bankers are the ones who are licensed by law to be able to deal with the stock of the company. Nobody else can touch the stock. It's illegal for any company, anybody, including the management of the company, in certain cases, to be dealing with the securities of a company. Investment bankers, brokers, broker dealers are the only one that are licensed by the government to touch, not issue, sell, and pretty much touch. It's like if you were a doctor, it's almost like saying that the only one that can hold a scalpel, a cutting knife, is the doctor. The nurse cannot do it. The patient can't do it. The owner of the hospital can't do it. It has to be a licensed physician that is holding the scalpel. In this particular case, the investment bankers and the people that are licensed inside the investment bankers, not everybody inside, because the secretary cannot do it. The CEO who does not hold a broker's license cannot do it. It has to be somebody in the investment banker that has a license. That is the only person that can promote and sell the stock. He's allowed to be able to talk about, I'm selling stock. Nobody else can say that. Nobody else can mention the word, I'm selling stock. You can say, I'm introducing to this company, etc., but you cannot do that. Then you have the lawyers and the auditors, and those are the entities that deal with paperwork that creates the documentation for the investment bankers to use and all other people. Then you have the regulators, and the regulators, the main regulator in the United States is SEC and FINRA, is a missing entity in here. And FINRA is much more important than the SEC. FINRA is the one that is really controlling the public markets entities. They're the one that goes inside to investment bankers and check them out, not the SEC. Okay, and then you have the exchanges, but the exchanges are really private entities. But although private entities, they have rules, exchange rules, but those exchange rules are not law. The SEC has laws, and FINRA has policies. So SEC, FINRA, exchanges, and then many other different type of regulators could be involved in it. But those are the main three regulators. Okay. And then you have institutional investors. So who is an institutional investor? Well, practically anybody who is managing money professionally and is also a trained professional, experienced, and most institutional investors also have to file for an application to be able to claim that they are institutional investors. So all funds needs to be able to have a fund certification that says that they are a certified fund. Okay. Who's that? Was that Lionel? Okay. Ting ting. And then pension funds, insurance companies, certain entities can actually be institutional investors as well. The most famous are the ones like BlackRock, Carlyle, KKR, and those very large fund management institution. Okay, Carol. Hello, Carol. Okay, and the next one in here is the analysts and the media. The analysts and the media are the special people in the entire market. The rest of the people talk very little. In fact, not even the CFO talks a lot. Investment bankers, when they're doing a transaction, they're talking. And so the only one that is actually communicating the narrative of the company are the analysts and the media. They are the investment relations people that are hired to be able to promote the company's communication message and narrative. Some analysts are independent, other analysts are hired, so are some media are independent, and some media you could hire them. to be able to relate your message. Okay, this is one area that is actually very, very little in seen, but typically when you have an IPO, then there must be a lot of analysts and media coverage, all the time. The secret for the public markets is none of the above. All of them are very important, but if you want to have a stock market that moves and communicates, you better have a good analyst and media. You don't have to have a good, market maker. You don't need to have a lot of good brokers, but if you don't have the message of the company properly communicated, then that company is not going to have a good, narrative that will be seen and listened to people. Okay, next. Okay, so let's go into details, and some of this may pertain more to Alphega and how we do things, but consider that Alphega is summarizing what is considered to be a good company and a company that wants to be good in the public markets in doing that. So in the case of the business, as I said, it's very difficult to improve a company that has a bad business model, and if without a company that has a good business model from the beginning, you have to work very hard to be able to change it. So you must have all the core elements in here addressed from the very beginning. Okay, so the business model needs to be well, financial performance, corporate governance, strategy, and M&A. I'm going to take a 1-minute break, please. Fundamental parts that makes up the core elements of the company is built into the mission and vision of the company, that is monitored by the office of the president, and we would seek to have a prestigious board of directors, good professional services, lawyers and accountants, and financial institutions, which means that we want to attract sophisticated investors, not just any investor. And the last thing in here that is very, very important is to be able to have the pipeline with the $60 million of EBITDA. If for Alphega we're able to have these 6 in here, we already would have the fundamentals, for the business and the company, because the business model is through acquisition, the financial performance, we're buying EPS, we're buying earnings per share, the corporate governance, we have one of the tightest, strongest corporate governance, and our strategy, even as a small company, is mergers and acquisitions. And of course, the thing in here we do need to be able to put emphasis in is in the narrative of the vision, as a story and positioning. I personally feel that that's one area we could actually put in a lot more emphasis. Next.
I have a practical question about
Please.
the M&A pipeline. Yes,
Okay.
we had several discussions this week how we can parallelize and speed up this process.
Yes.
So the practical implications will probably be that more people will sign the NDAs, potentially even the LOIs. And I was asking myself, in Germany at least, you need to get that power, I think, from the CEO before you are allowed as non-CEO to sign certain documents. I think we also have to consider this now. And does it already apply for the NDA, for example, if I want to sign them, or Shabnur or anybody who is not CEO? And what about the LOIs?
Well, let's leave that as a technical question for the company.
Hmm.
But in general, I would say that anything that can be done to be able to expedite and facilitate things, to be able to have more NDAs and more LOIs, and now just be aware that the NDA is very simple because it's the same piece of paper, it does not change.
Hmm.
That agreement has been approved by the lawyer, so it's just the changing of the person, top and bottom. And then so it's very easy for anybody to be able to sign an NDA on behalf of the company. In the case of
Okay.
the LOI, there's also a template that, as long as it's just using the same template that has been reviewed by the lawyers, just changing the names and so forth in it. But every time that is something that be added in there, then that of course is something that you want to always modify. I'm sorry, verify.
Yeah,
But
I didn't mean changing the document. It's about I think in English it's called signatory authority. Do I have this authority, or do I have to ask Luis that he's essentially
I
transferring this
believe
for
that
certain documents to
I
me?
believe that Shapnor and Luis can approve, for you to do certain things there.
Okay.
When
Yeah.
you discuss with them, yeah.
Yeah.
And then
Thanks. Mm.
all I'm
Mm.
saying here in this discussion is that we should do everything we can to be able to increase the pipeline, because, as I said, to
Yeah.
get to $60 million in pipeline or more, let's not stop at it. If we
Yeah.
can have $1 billion in pipeline, let's do that. That's very important. Thank you.
Thanks.
Okay.
Understood.
This document in here has not been circulated for a while. We typically used to have it in every onboarding, but obviously, many things have been very busy for everybody. And I'm not gonna try to go over it in detail in this call because there's many other things here. All I wanted to show you is that from the company's perspective, there's always been a evaluation guideline that says that if we want to achieve an IPO of 300 million, we would first, look into a PE multiple of 15. We will also look at a price of the IPO to be $10. We will also look into a target EPS of a minimum of 67 cents. And we will look into not issuing any more shares than 30 million to 50 million shares, upon getting to IPO level. As an example, for AIC, I believe that AIC has only issued about 13 to 14 or 15 million shares. So we're very, very, below the $50 million share mark. Okay, also has a debt coverage ratio of 1.3. It's also founders and management initial ownership of 20%, and it also has a stock option of 15%. So that is something has been planned from the very, very beginning, in not only one company, but all companies. And, certainly, Alphega Innovations is one of them that fits that. Okay. So that corresponds with the core elements of the business, and in more specific way, insofar as the SPVs that we, are managing or are developing. Okay. We'll have this presentation sent to everybody here right after the call. You can actually read this more in detail. Okay, so because the narrative is so important for the company, the most important thing for the company to be able to have a narrative that everybody can articulate is actually to have it in the mission and the vision. In fact, the job of the CEO is that after he or she is done with the key elements, the next most important time is that it should be spent talking about the mission and the vision of the company every day, all day long, over and over and over again. For Alphega Innovation and Alphega in general, we're talking about a mission that adds soul and purpose to companies. That is a company that is in the culinary level economy, and that is a company that pursues large opportunities through mega trends, and specifically in the areas of corporate and personal wellness. Okay, you can refer to the actual AIC document, but those are the things that anybody that stops you in the street, you should memorize it, immediately, to be able to explain it and mention it, repeatedly, because that's the narrative, of the company. What does the company do? What is its mission? What is the vision of the company? Okay, and that applies to all companies in all public markets. If you stop a CEO, if you stop Tim Cook, the chances of him not be able to articulate the vision and mission of Apple is practically zero. Or any of the S&P 500, they are made to memorize and articulate. So if they stop, they wake up at night, and they ask them in their sleep, they'll be able to say it. This is very important. Okay, next. Okay, this is just to show you that from the very, very beginning that the company started as a corporation without much, it already had a step-by-step plan that it works into the internal valuation. And as we said, if you go to the curve on the right-hand side, there are three curves. There's the full valuation curve. There's the blue line, which is the intrinsic value of the company, and the red one, which is the offer price of the company. The idea in here is that because we know that the market is what determines the price, but we want to provide some guidance that lets everybody know that the full valuation and what the prices are being offered are undervalued, which we're basically signifying that the price that we're setting it from the company in here is a fair price or better than fair. Okay, so that is to address the valuation. At the end of the day, as everybody may recall, I've said it many times, is that the management may decide what these prices are, but if the stock cannot be sold, then you have to change the prices, because the market is the one that always determines the price, not the company. Okay, next. Okay, this is an example of the trenches. It does not mean that every company will be the same, but it shows that it was designed so that the early shareholders can actually have a very, very high return on investment from one tranche to the other. Okay, and then going into the IPO is supposed to still have a above average return on investment, even going into the month before going into IPO. Okay, here we're talking about the very, very early stage of the company, which makes the return on investment for the investor ultra attractive. Okay, but again, this is nothing more but an example how management will design a valuation structure, but it is only when you go out there to the street to promote it, is that when you get somebody to actually make an investment at the price that you're seeking for, then you have validated that valuation, that internal valuation. Okay, any questions? Okay, next. Okay, and okay, maybe this is an extra slide in there. So next. Okay, so we're back here into the markets. Now we're really talking about the markets. So let me go into opening up this big animal here, which is called the public markets. And this is the public market specifically of the US. The US market started in 1792 which is more than 230 years ago. And the Amsterdam Stock Exchange started in the 1600, which is probably about 100 years earlier than this. The Dutch and Amsterdam Stock Exchange was the first official stock exchange that was opened up in the whole world. There was no stock exchange in the whole world before the Dutch and Amsterdam Stock Exchange. And it occurred in a bridge. It did not occur in a building. The original Amsterdam Stock Exchange occurred in a bridge. So did the US New York Stock Exchange occurred in the corner of Wall Street and Broad. And that's where people get together in the coffee shop that is in the Wall Street. So when people talk about Wall Street, it's a street called Wall Street, and there's a coffee shop there, and people get together in the coffee shop to buy and sell the stock. Okay, so that was almost 230 years ago. Since then, and by the way, New York, which is where this U.S. Stock Exchange is, was called at one point in time New Amsterdam. And I wrote an article that explains why the New York Stock Exchange inherited all of the features of the Amsterdam Stock Exchange better than London. No place in the world has those features. Amsterdam, Manhattan, to be specific, because Manhattan was part of New York today. In New York, before it was changed to New York, was called New Amsterdam. You connect those pieces, you found out where the DNA of the whole thing comes together. Anyway, right now in the US, they are being consolidated into 4 groupings of the markets. The lower one is not an exchange. It's an over-the-counter. It works almost like an exchange. It also has the stock symbol. In fact, when a stock in NASDAQ or New York Stock Exchange is kicked out of the exchanges, they will go automatically over to the OTC. Okay, so the OTC is a place that you can still buy and sell the stock. Okay, here in the right-hand side, it shows you some, with the stars as to what is better for the NASDAQ, the New York Stock Exchange. There's actually, the NASDAQ and the New York Stock Exchange has 3 layers, and the top layer is the one that is the more robust, the more sophisticated. That's where the S&P 500 companies are. But then you have one that are on the lower tier that is called the NASDAQ Capital, and the New York Stock Exchange is also called the Amex, American Stock Exchange. Okay, so companies that are new, like ourselves, that are on the emerging growth area, we would typically go into the NASDAQ capital markets, and then from there on gravitate to the national global markets. Okay, any questions?
Just a comment that it's very curious how the OTC market is opposed in capabilities with the New York Stock Exchange. It's the opposite. High
Say that
listing
again.
requirement.
Yes.
I mean, OTC market, high listing requirement, not too much liquidity and financial capability, but the New York Stock Exchange is the opposite. That is really curious.
Yeah, the New York Stock Exchange and NASDAQ has a lot of restrictions. You cannot just, apply for it. The OTC, any company can apply, whether you're making money, not making money, whether you have, 100 shareholders or even 60 shareholders, you could be in the OTC. For you to be an applicant to the NASDAQ or the New York Stock Exchange, you need at least 300 to 400 round lot shareholders, meaning 100 shares and above, to be able to apply. And there's a lot of restrictions that allows you, not anybody can be in the NASDAQ and the New York Stock Exchange, but anybody can go into the OTC public markets. You don't have to make a penny. You don't have to have any revenues. You could be in the OTC. You don't have a large number of independent directors. You can be on the OTC, because for you to be in NASDAQ and New York Stock Exchange, you must have independent and very highly trained management team.
Thank you.
Okay, but on the other hand, there are a lot of flexibility in the OTC. It costs less. The difference is between $50,000 per year, or to be in the New York Stock Exchange, the minimum would be $500,000 a year, and if you're in the top tier, you could be paying $1 million to $3 million just to as a membership fee in the top tier of the exchange. In the OTC, you could get away with $30,000, even $25,000 to be able to be on the OTC. So for many companies that get delisted, or because they are near bankruptcy or whatever, they just automatically go to the OTC. But OTC is a non-institutional grade place. Do not expect to get any major investment being in the OTC. Okay? It is not institutional grade, and we only want to be institutional grade. Okay?
Good.
Next. I just thought that I show here the comparison of the U.S. and China. It's not a 100% comparison, because, as I mentioned, China financial markets is highly controlled by the government, and the U.S. is not. But for all practical purposes, China is the second largest stock market in the planet, and the U.S. is number one. Okay, and that is the case. I expect that China will have a chance, because it's just more people in China. Now, in comparison, China listed 25% more companies than the U.S. in the year 2025. However, the valuation in general for the U.S. companies tend to be much higher valuation than China. So China will get the numbers, and the U.S. gets the quality of size. So, for example, China has a total combined value of all companies together of about $15 to $18 trillion. The U.S. in comparison has $49 trillion with less companies. Okay, so the table below will show you that the U.S. has about 5,000 companies, but China has 7,000 companies. And so the U.S. commands about almost $50 trillion, but China has, almost 40% more, but it has a market cap that is, about 40% less than the U.S. On the right-hand side is actually even more interesting, because the Dow Jones Industrial, which is over 100 years, and below is the Shanghai, the SSE, Shanghai Composite Exchange Index. So the Dow Jones is today, of course, at 45,000, and Shanghai as 3,000. But you really can't compare that, because the Shanghai Stock Exchange has been in operation less than 30 years, and the Dow Jones has been in operations for over 100 years. But what you do have to look at is the shape of the curve. The shape of the Dow Jones has practically been consistently increasing. And the 30 years that China's stock market has had, it's actually been a zigzag. Okay? And it's not the purpose to be able to compare why or whether one of them is better or not. I'm actually showing that the two largest, equity markets in the world have different qualities, and that's why we're actually involved in the U.S. capital markets. Next, please. Okay, so to be able to be successful in the market, a business has to have a complete system with strategy, operations, and finance. And the key word in here is alignment. They all need to align together. Whether they are better or worse, the most important thing is that everything matches together so that they're actually aligned. And then when all of the parts of that alignment works together, can the company be scalable effectively and be able to attract sophisticated capital? That alignment is what makes that attraction of capital occurs, and of the markets to be able to be put together, because everything in the market has to do with the narrative, and the narrative is to be connected to the trust. So if the company has very poor governance, meaning that you cannot trust the company, the narrative is not going to make any difference, and therefore whether you say that the company is making money or losing money is not going to make much difference. There are many situations that the company is not making money and in fact is losing money, like ChatGPT, and still is able to actually gain a lot of valuation. Now, ChatGPT is not a public company, but that kind of narrative and that kind of trust that Sam Altman tries to convey by having dinner with the president and all that is all so that people will say, oh, he's a trustworthy person. Okay? And then his narrative is able to actually come out to the market. And that is what gives the public endorsement and the public value. So that alignment of all of those things put together is very essential. Next, please. Okay, so again, this is to bring out Elon Musk, and you can actually see in this very, very clear case why the narrative is more important than the fundamentals of the company. Great companies can do poorly in the market, and bad companies. Now, Tesla is not a bad company, but it's clearly not making a lot of money, but it has a PE that is over 200, which is unheard of. SpaceX is actually worse because SpaceX, even as a private company, has a valuation of over 500 in PE, price earnings. Okay? But that shows, one of the brilliance that Elon Musk does very well, which is to be able to have a good narrative, and to be able to have that narrative be able to be conveyed, and that narrative conveyed and communicated properly, along with the trust, because he helped the president, then buys him a lot of trust, buys him a lot of value. Okay, so I want to use here as an example of Tesla. The team in Tesla was actually Morgan Stanley and Goldman Sachs. So those are top 5 names in the U.S. Okay, and although Musk get into a fight with the SEC, I believe that that's all really just propaganda. He likes to do that to get his name out there, like Steve Jobs says. Good news, bad news is news. And by the way, this applies very much to the public market. Okay, good news, bad news is news. Okay, next. Okay, because the market is really what determines price, you can actually see on the left-hand side, that is a chart in 2008 when we had one of the worst financial crises that we've had in modern times. And at the beginning of before the crisis started until the end, just 2008 to 2009, just roughly about 1 year's time frame, the market itself lost $37 trillion over that period of time. Then, of course, everything went back up again, and now the market is above the 2007, 2008 level. Now, something in here I want to actually add just to make sure that you understand. When you hear Warren Buffett or Benjamin Graham mentioning that the market is an emotional machine, it behaves like an emotional kid, that in a way is true, because underneath all of that ups and downs in the entire market, and now that the Jones is at 45,000, in reality, the Dow Jones did not gain a lot of value, because if you look at it from the right-hand side and you normalize the value of the Dow by resources, because stock is highly speculative, is not solid, right? Nobody says that today that your earnings per share of $2 will earn you exactly the value of the market, of $15 or $30. If it's $2 times 15, it should be $30. But sometimes it's 30, sometimes it's more than 30, sometimes it's less than 30. Okay, so it has that volatility in it. And the Dow Jones in general, when you compare it to actual real value, it has actually lost purchasing power, like all of us that have cash has lost purchasing power. So in the case of the Dow Jones, the prices of the Dow Jones went up to 45,000, but when you compare it to gold, oil, or any commodity, you'll see the shape that it shows on the right-hand side there on the red of the graph. Okay, so that's the Dow Jones, industrials divided by the price of gold, and you can actually see that it's not going up. In fact, actually, it's going down, although the stock of the Dow Jones has gone up to 45,000. The value of it, when you see it through a microscope, is losing value. Okay, the key point to all of us in here is that no matter whether it's losing value or gaining value, we're riding the wave of the inflation. We're riding the wave of the inflation. So although the US dollar is deflating in value, the stock is going up in value because the US dollar is going in the opposite direction. So as long as we hold stock, we are better off than holding cash. Okay, that's my selling point for this chart. Okay, next. Okay, so far we've covered the market dynamics. There's a lot more. I'm not able to, in this short period of time, go into it. That's why this is called a basics in it. But everything that I'm giving you in here, will be able to answer, everything in large details once you start digging into it, even if you do it by yourself. And so in the next 10-15 minutes, I'm going to go over the structuring, the execution, and the maintenance or sustainability portion of it. So going into the IPO and post-IPO. Okay. Again, a public company succeeds when the business is strong and there's investment flow that is aligned, and the team is institutional grade. Okay? Institutional grade starts from having the mindset of being an institutional grade and not a mom and pop. That's very, very important. And of course, many will be hiring public managers, will be hiring institutional grade managers, but at least everybody needs to know that when these managers are being interviewed, they should be speaking international grade language, corporate governance, and they should be able to be speaking earnings per shares, the way that we do. Otherwise, they will not be considered to be a institutional grade team. And this is predicated in the fact that the team, which was something that we can control, we may not be able to control the market, although we can. We may not be able to directly control the business as it operates, but we could actually make sure that we can control the people that we associate with. And that's one of the biggest problems that companies have, is dealing with low-level people. Next. Okay, so insofar as putting together the pieces for getting into the IPO, there needs to be a syndicate that is put together. That syndicate includes underwriter syndicates, who are actually the ones that are responsible for creating the IPO. But then there's due diligence, and there's also a roadshow that occurs during the IPO. Now remember, between now that we're a public company and the various pipe investments that we make, and the fact that we actually become a publicly traded company, okay, then we still have the IPO. And the IPO is actually signaled when we're able to reach a $300 million valuation. That means when the earnings per shares of the companies become 67 cents and above. Okay, and then the last thing in here that needs to happen is that we need to be able to look into the investors' distribution. In other words, how is the stock spread about all entities? Because that's the main thing that the underwriters will be concerned about, because of the we'll talk about it in the next slide. Next slide, please. Okay. Again, this is a reminder of what we should have done from the very beginning of the company. Now the IPO times, and before it gets into the market, this is a mental check to see whether we're still focused on the valuation of a minimum of 300 million, that actually we have acquired enough companies that provides us with the earnings of shares of 67 cents, that we're actually done our share issuance to be no more than 50 million, give and take, okay, 30 to 50 million shares. That allows us to actually negotiate strongly with the underwriters to make sure that we can actually get a $10 per share price. And the rest of them is gravy, that the founders and management team keeps 20%, and the stock option plan is for 15%. Okay.
So, Mr. Chen, I have a question. So
Yes,
I'm just
Dr.
looking at it from point of view of AIC, like, how we are progressing. And so we still have like a few steps to go through at this point in time, right? So this is where our strategic direction comes into play, right? Like when I'm looking at this slide, I'm trying to understand, I don't know if it's for a discussion here or later on, but I'd be interested to compare our progress and then how that can be accelerated.
Okay. Nothing has changed from the fact that the valuation of 300 million is the milestone that everybody is seeking. To be able to get to that milestone, we need to be able to acquire enough companies to be able to have a 67 cents per share or more. And to be able to get a good enough EPS, we need to be able to make sure that we don't issue too many shares above that 30 to 50 million shares level. So at this moment in time, AIC meets all of those. We don't have a lot of earnings per shares yet, but we do not have a balloon, capital structure, meaning we only have like 14 million shares, 15 million shares issued and outstanding.
Got it. Thank you.
Okay, next. Okay, so no IPO happens without a coordinated institutional effort, right? I spoke about alignment. So in the preparation of the IPO and the execution, the most important thing is human alignment. We're dealing now with high stakes negotiations, okay? If people would kill their brothers and sisters and parents and so forth for, you know, for $1 million or even less than that, we're talking here about big competing, you know, dollars and cents forces. So there's a need to be aligned the competing agendas and the conflicting agendas of various parties. Now, hopefully, the way that things are designed and the way that we design things, we have everything very much kosher, you know, from the very beginning. And, you know, what happens, for example, is that before getting into an IPO, there may be some funds that have invested into the company and they have their own agenda. Everybody has their own agendas. Even the auditors have their agendas. The lawyers have their agendas because they are on a dollars and cents payroll. So if they are able to drag more, and the lawyers love to be able to write more documents because they get to charge more money. The auditors always like to ask an extra question and check an extra piece of paper so that they can make more money. The underwriters, you know, needless to say, these are that they make money on the commission basis, but they like to be able to get extra fees for everything else they can. So there's a lot of conflicting agendas in it, and so the job of an IPO is to be able to go into it, you know, as aligned as possible. Okay, and that starts from the very beginning, and that's why we have everything systematized and templated, you know, all the way to the end. That does not mean that comes to the last minute in here that there will not be somebody that says, no, I don't agree, and there will, you know, things will drag. But I've seen many cases in China, for example, when you have investors, because most to be able to do a IPO in China, you need to transfer all of the Chinese owners into the public markets in the US, and some of the funds can't do that. They simply can't do that. Well, they have to go through a lot of effort to be able to do that, and then that ends up sometimes killing the IPO. Okay? The other thing that needs to happen is that everything that has to do from the point of view of the IPO is on a time and market-driven basis, but I say time especially because the IPO has a window. If that IPO window is not met, then there are actually severe losses involved with it. Any delays or anything in here could push up the IPO schedule. Okay? So it's very important that the company from day one operates already with time priority in their minds. That's very, very, very fundamental. Even valuation, earnings, and everything comes second to be able to practice and have a culture of being time and market sensitive. Okay? Once that is in place, then you actually can see the indication of interest and the expression of interest come, you know, in time. And that's one is beginning to signal that you actually are, you know, ready to be able to go into the IPO process. Okay, next. This is just a sample of a milestone table, and it goes from milestone 1 to 12. I think it's very important to always have it, you know, in our case, and always, you know, follow it. And if for some reason we deviate from it, that everybody puts the major effort to be able to make this happen. This should be a document that should be from the point of view of a serious participant in the company to be no nonsense. If it's not in place, it should be in place. And Eric, your German perfection, this is where it should be. Why are we late by 3 microseconds, guys? Okay, next. Okay, here is the alignment of the team. I'm not gonna go over it, anyone in details, but there's the deal structuring aspect. Really, how to present the earnings per shares. There's also the primary shares. In primary shares, meaning that money that buys shares, new shares are issued. So that means also that the money goes inside the company in exchange for shares. And there are the secondary shares, which means that the shares has already been issued by the company. So any transaction that has to do with secondary shares, that capital never reaches the company. But it helps the liquidity in creating the volume of the capital flows. The other thing that is important is that during the structure is to be able to see the capital raise versus the insiders cashing out. So that's an area of negotiation. And the last one that has to do with that is always the use of proceeds. People will always ask, what are you going to be doing with the money? If it's to pay old debt, then that's not good. Everybody wants to see the new money coming in to be accretive, which is to be able to buy new value into the company. Okay, and so in this case, the deal structure has to do with the company getting capital and everybody, getting paid. Lawyers want to get paid, underwriters want to be paid, some of the employees want to get paid, everybody wants to get paid. Yeah. So the second one has to do with the reality of the valuation, which is negotiated. The first negotiation goes with the banker and with some investors. Okay, everybody wants to get a discount to what the public market is going to be. Okay, and everybody will be seeking for, or an investor will like to be able to fight to be the investor that has the most influence. Okay, so in this case, for our IPOs, we have everything designed so the IPO pricing is pre-negotiated to be $10 per share or above. Okay, not calculated, pre-designed. And then there's the book building mechanics, which is how to collect all the people who will be buying the stock when it goes to the IPO. That is a job that the underwriters do, the brokers that participate, and they do that through either expression of interest or indication of interest. There's also a negotiation for what happens if the IPO does very well. Do the company get to have an oversubscription level? And then of course, who gets what in the massive, money creation of it. We're dealing with, you're talking about hundreds of millions of dollars, so everybody wants to get a piece of the action. So in this book building exercise is also really is determined who actually controls the post IPO. In other words, we're getting into the IPO, but you can actually see the colors, of it being developing, so that when the IPO occurs, you can already predict what is going to be happening, post IPO. Okay, next. Okay, and the last piece in here, which is really the IPO is one day, and that's like a day of the wedding, and then you have to go and suffer the rest of your life, sustaining, the marriage. So go there. Okay, so number one, and above all, of course, during the IPO process, everything should have been designed so that the underwriter is in full control, so the IPO goes smoothly. But then, of course, then you have to worry about the post-IPO after the IPO. And so that's why there is a period of about 3 months to 6 months. Sometimes it's longer than that. So for prices to be stabilized, and to some degree, that is both the incentive and the work of the underwriter working with the market support people, market makers, the news. They buy a lot of news for a big IPO. And, on a big IPO, if you look into any IPO, it doesn't matter which one, the big ones, Facebook, you never hear about Mark Zuckerberg, It's a name that you cannot even pronounce. Most people can't pronounce it. It sounds like a sucker, suckering the bird. So nobody knows Mark Zuckerberg on day one, but then it goes into national TV. It goes into Newsweek. Oh, he's the genius. He's as good or better than Bill Gates and more handsome, which is not true. Bill Gates is not handsome to start with. He himself, say that. He's just rich. You don't have to be, handsome when you're rich. And so all those things, but the market just create this persona out of you, to large proportions. And then that goes on for 3 months, 6 months, 9 months. And then you never hear about, Zuckerberg, or whoever, after that, except for Elon Musk. And that's why Elon Musk is so great at his promotion in it. Elon Musk by himself is a very good actor. And Zuckerberg is actually not a very good talker. He's a very boring guy. To start with, he probably is the one who chose the wrong name for the company from Facebook. He should have kept Facebook, but they changed it to Meta and all those things in it. And so, that's why you want to keep them in the closet, and then you need to get the news, people out there. But the narrative and all of that in here is what really goes on, and all of that narrative is being controlled really by the underwriter. Okay, and there's something that's called the green shoe option, which allows the underwriter to practically legally manipulate the market to make sure that the prices are all doing well. The means the ends justifies the means. So the end is that there's stability of the IPO. The means is that you do everything you can to be able to make that happen. Okay, so the IPO success is not really about going public. It is the engineering of the demand, the controlling the allocation, and the managing of the first 90 days. A little bit more at times, but 90 days. Next. For the longer term, nothing different that was not set, that was planned for day one in our case. But of course, earnings and expectations are very important. Remember, the company should continuously acquire so that the earnings keep on growing. Remember what I said, a company that has growing earnings will not necessarily by itself naturally be good in the public markets. That's why the management of the expectations and the earnings need to be combined together. And managing of the analysts, and also consistency is very important. Secondly, is that the management of the investor base, it needs to be very, very good. That's why I've said from day one that the people coming in needs to be vetted. You don't want just any ordinary people coming in to be a shareholder. Okay, if they are holding 100 shares, it's fine, not a big deal. But anybody who's holding too many shares, the institutional investors don't want people of the same quality that they are dealing with. So institutional owners hate anybody that is not institutional. That's why when the VCs come in, they don't want any angels in. They do not want any angels investors or family offices if they can help it. So this is a way that you could tell the people, including family offices, this is your only way to be able to get yourself to IPO, because if you don't, you are not going to be able to go in. Okay. Number 3 is capital allocation. When in the long term, this is the most important part, because people will be looking at where you're spending the money. If you're spending the money to just have some fun, or you're spending the money to keep on acquiring revenue generating companies, or at least if you're spending the money, just go back, buy back the stock if the stock is cheap. Okay, and of course, if stock is being used, it should be used as currency, and that's actually very good, capital allocation message to be able to send to the market. Okay, number 4, I've said it many times before, the narrative and the market perception is the most important thing that sets the success of the company in the public markets. Bad companies can have good market results, just like good companies can have, because of bad narrative or no communication, bad market results. Okay? And institutional credibility starts with governance. When things go bad, you call up the people and say, well, I really messed up. It was a blunder. It was a mistake, but I'm fixing it. Okay? If you don't, then you're not going to gain any credibility. That's why many companies, although the CEO is good, but the CEO is where the buck stops with the CEO, and things sometimes have to show that the CEO needs to leave or somebody needs to leave to be able to take the accountability for what that happens. And so when that person leaves, then the market rallies. Okay, and same thing with investors. That's why in the U.S. especially, it's very important to be able to be very transparent and to tell the investors we're heading into an area that we're going to have a lot of problems, a lot of uncertainties. We're going to do everything we can to be able to survive it, but there may be a rocky period that everybody is pre-warned and knows that everything is kind of okay. And the last but not least is the discipline. Corporate discipline, military level corporate discipline is everything that should be in Alphega. Nothing short of it. Anybody who says that the company should not be spending its effort into being a disciplined corporation should actually leave. I have not seen any company. It's already hard enough to be able to maintain a company with good discipline. A company that has no discipline, that says things that cannot do it, that company should cease to exist, or should find out who talks and doesn't deliver. Okay, so everybody in management, everybody who's actually looking into this and here, I want to finish this thought by that portion of the corporate discipline. Okay, I think that we're almost to the tail end. Do I have another one? Next. Yeah, that was the last one. Okay, questions.
I have a quick one. So
Yes.
how important or how relevant is the IPO stock price?
How relevant is the IPO stock price? Okay, there is a technical requirement that is to be at the senior exchange, you must be above $4, $5. And you have to be, like I said, paranoid, like Andy Grove teach you to be, is that only the paranoid survive. So you have to think about Murphy doing all kinds of crazy things and your stock takes a dip. So if you start at $5, at $6, and then you go below $5, you're going to get a delisting notice from the NASDAQ. They're not going to like that. So $10 tend to be at least safer. You could say that $20 is better than 10, but $10 is a very practical one, and here is because it's the one that SPACs do all the time. And since our methodology in here follows similar to SPAC, not like SPAC, but similar to SPAC, $10 is the price that we typically want to push for. It makes it simple. It saves the underwriters from doing these computations for which you have to pay $500,000 just to figure out what is the proper price of your stock. So set it at $10, do everything to be able to work it out, so it'll be $10. Now that is the both the practical reality and the and the regulations, or the application for the regulation of the stock, both of them simultaneous. Okay, of course, the valuation needs to also coincide with the multiples, needs to coincide also with the growth trajectory, and also needs to be able to be with the industry, and the business model of the company. If the company has a very low margin, like 3 to 5%, well, that's going to affect valuation. If the company has not grown for the past year, and you don't have any projections for the pipeline to grow, and that's the reason we use M&A to show that we can grow infinitely in one transaction, then of course it's going to affect valuation. So all of those things have to come into place. But the first one in here starts with the EPS. 15 times EPS. That's the standard that we seek.
Okay, thank you.
I have a related question. You already partially answered it. So far as I understood, the two parameters that we have under control is telling a good story, and the other one would be to keep the pipeline running so that we have continuous growth. In order to, I observed it quite often that after an IPO, when this initial euphoria is essentially calming down, the stock price might take a dip. And if you want to avoid that, I'm asking myself, which knobs do we have that we can turn to essentially have a continuous growth up from there? Partially you answered it. Are there any additional knobs that we can have under our control, or did you already mention everything? Yeah.
Well, the thing that affects stock prices is selling pressure. Unless you have some bad world news or something like that, the market, as you asked, does the market care about the government policies and the wars and all that? The answer is no. Okay, but what the market will be highly affected is that as the underwriter is selling the stock of the company in the public market, there are competing forces selling the stock against its price, because the underwriter wants to sell it at $10, and one stupid guy wants to sell it at $8, just because he wants to pocket $8 because he bought the stock at $1, or even $5. Then the underwriter will be penalized because that's creating selling pressure, and he or she will have to go and buy that stock. And depending on how many shares are out there, then that could create the pressure on it. Okay, so that's why the structuring of all of the shares, as I mentioned earlier on, is very important. And typically everybody gets locked up in some kind of a lockup provision, agrees not to sell the shares, but there's some people that are negotiated that they're going to sell the shares, but those people have to be managed in such a manner that they're that at least it's an issue of supply and demand. If you have a lot more people buying, then the demand is high enough, then the supply is not going to affect it much. But if you have oversupply and not enough demand, then the prices are going to actually start caving down. Okay? So part of it could be design, and the other one in here has to do with one word, just corporate discipline. The company is going to be and has to be as responsible. I mean, let's face it, the underwriter will insist it. No underwriter will go in it just thinking, it's fine for people to just flood the market with stuff. This is absolutely not going to happen. So, but it's going to take the company actually to be serious about it. The problem that I see is that there's a lot of people in the company, including the founding team, that want to cash out. They've been at it for a long while. Let's face it, do an IPO and all this thing here takes a couple of years. The water is getting dry. The family is asking you know, the spouse is asking for the diamond ring or the Ferrari or whatever, you know, and then, you know, when are you going to sell their stock, Eric, you know? And so that's the pressure that comes in for the founding team as to how much do you cash out, when or later. And that's why in most cases, management needs to be, you know, held, and they're giving like negotiations. Okay, you could have a couple of $1 million. You know, the case of Alibaba, Jack Ma was allowed to be able to get, I believe, $2 billion. You know, from the selling spree. But you know, Alibaba was the largest IPO on the planet at the time, so they sold $28 billion of shares to bring back to the company. That was the IPO, and so they allowed, you know, a couple of, I think it was like 8 billion shares to be between Jack Ma and some of his, you know, management guys and other, you know, special investors, anchor investors. So that's the pressure that happens in it. And in the case of many other companies here, the temptation to want to actually cash out on the spot is very high. Luckin Coffee is one of those examples. The guy cashed out and not enough. He went out and borrowed money against his stock, and he wanted, you know, a couple of $100 million, you know, for an IPO that was a couple of $100 million. Okay.
But isn't that a better strategy to borrow against the stock instead of selling it?
Yes, always.
Yeah.
Always.
Isn't this how Elon also bought X?
Yes.
And also it's a tax optimization, I think, because when you borrow, you have less earnings on the paper. Okay.
It is. Well, you have less earnings, you pay less taxes. Is good. You know, Elon is not a, you know, I mean, he's going to be the first trillionaire of the planet. He's for sure not a dumb guy. Whatever he does, we know we cannot go wrong imitating him. Yeah, if he smoked marijuana with Joe Rogan, you go there and you do the same thing. I mean, I don't smoke, so, but, you know. Yeah, if he sneezes, you sneeze. Yeah. You don't have to like the guy to be able to be successful, okay? Successful people are successful people because of certain things they do, and if it works for them, you know, the ends justifies the means. Very good. Okay, any questions? Any questions?
I will do. So, is there any symbolic business case for where a IPO went wrong because people misalignment?
Oh, a lot.
Some recommended
I
case.
even come up, but I'm very sure I could, you know, get a couple of them. I mean, I could get a couple of them, you know, but the answer is yes. That's why I say lack of alignment is something that is controllable, but people need to be aware that needs to be total alignment, because the consequences of not having alignment is that it could affect the IPO.
So I think just to add to that, Mr. Cheng, so one is, of course, we have the whole corporate strategy blueprint and we follow that, but there's also a big focus on corporate governance as well, which the more time I'm spending in business, I'm realizing how vital that is, especially running a public company, the governance piece. And this is also like there are special cases and clauses that one needs to be trained into understanding, and it's not like we know stuff. So that's another piece which I believe is extremely important.
Yes. Steve Jobs hired, you know, whether it went well or not, you know, Scully to be able to, he was professional. He was a lot more professional than Steve Jobs. And that's why he was able to get the board, you know, in place until Steve Jobs learned how to do that later. Steve Jobs did not know how to handle Apple in the old days. Okay. So that's the same thing in this case here. But what is important is that everything that I've said today, okay, anybody could actually memorize it, review it, and ensure that the person that comes on board to be the CEO, to be the CFO, is following that. That is important. That's why I wanted everybody to understand how the market works. In fact, the way that I explained to you how the market works, even the CEO and the CFO may not even know it. This market dynamics in here is really not easy to handle, right? And that's why it's very important to be able to have competent CEOs that have governance, that have everything in place, so that when they take the helm, they have to follow those instructions. If not, you kick them out and you get a new one. Okay. So again, this is not for you to be able to you're gonna go and memorize everything that's happening so that tomorrow, Shapnor and Luis Carlos, you will be the CEO when it's gonna go to the IPO. When you start moving into the direction of the IPO, as soon as that happens, we're gonna start interviewing for the CEO. It's gonna be somebody who commands the market, who has reputation, has credibility, and all that. Right?
Yeah, and I think that's an important piece as well. I mean, for many of us who are coming on board, it's like our objective is not to be running these companies. Our objective is to be on the boards and and create multiple opportunities and enjoy the benefits of that. So our hard work goes really into building that ecosystem and then leveraging.
Yes, that's right. That's why to some degree, it is very possible what we're trying to do. Is because we're not asking for any one of us and to be able to do the impossible to be able to be at that level, right? Even I myself, I may be able to do it, but don't ask me to do it ever. It's something that I will never do. I use that word never very rarely, but I've been there. It's not worth it. It's really not worth it. It's probably a lot more enjoyable being a fractional owner of these companies. All we need to make sure is that the persons who are actually spending their daily time managing the companies for us, manage the companies for us. Not drinking coffee. That's it. And that's why the governance and everything is in place. We tell them, we compensate them very highly, just like Apple has compensated Tim Cook very, very well, and all these people, okay? But not everybody is like a Tim Cook. Tim Cook is a real professional at delivering value for our shareholders. Some other people in here are collecting in here, just sucking dry the company, from salaries and perks and do nothing.
So in that case, Mr. Chen, when we are when we are hiring at that stage, it'll be people who bring the competence as CEOs or management teams who have experience in running public companies, right?
Yes.
So I think that is another criteria we have to keep in mind, that we are not taking them through a training process to become.
No, please, no.
But otherwise, that
no.
too much time and effort.
Everybody in here came in because of special character, personality, that everybody believes that you have a mission in life that pertains. Because let's face it, many of the people who are coming in as professionals do not have a broad humanitarian big purpose in life. Okay, they're coming in as professional. You tell me what to do. I run the company. You want to go from 300 to 300 billion. Okay, or that's their job. Okay, and all they're actually doing in here is committing to do it, and that's what they're professional about. You don't care whether they are Catholic, Christian, Muslim, Buddhist, Jewish, or atheist. Okay, and they could be non-believer, in nothing except just getting the numbers in. Okay, in our case in here, everybody comes in because we believe that everybody has some purpose in life to be able to create this purposeful mission in it. Okay, so I would say that is a very, very important part of the whole process. The people that we hire as a professionals, they're being hired to get the job done. This call is being recorded, So if you want to use it to be able to translate it to any other languages internally, this is not to be sold. Is to be used within the Alphega group. Okay, as I said, I have not done one of these for a long time. The last time I did it, it was not with these pretty PowerPoint. It was drawn in a blackboard, impromptu, but we got 2 unicorns out of that. So I feel proud about the content. But honestly speaking, I believe that there's a lack of information on this, in general. Okay, so I would suggest that I'm leaving this on record. Anything that you need me to be able to provide you, I'll be very happy to do that. And then, hopefully I don't have to do another one of these in here for another 8 years. And hopefully from this call in here, if last time I did it, got 2 unicorns, this time in here, I expect to be able to get 20 unicorns or maybe 50 unicorns.
Yes.
Okay?
Yes. Thank you so much
Okay.
for your time. Yeah, really appreciate
Absolutely.
Thank you so much.
This
Thank you
time
so
was very
much.
good. We got good questions. Good questions lead to a good understanding. So more questions.
Good.
Thank you very
it.
much.
Thank you, everyone.
Thank
Yeah.
you.
Thank you. Thank you very much. Yeah.
Thank you. Bye-bye.